Well, we continue to live in uncertain times, don't we? Never before have there been so many unanswered questions. Was March 2009 the bottom of the GFC? Will Greece go broke, and what impact would that have on Australia if it happened? Is the US heading for a double-dip recession? How high will the Aussie dollar go? Is China's insatiable appetite for our precious resources sustainable? The list just goes on and on. And we all know that no one has all the answers to these questions, hence the uncertainty. And again, as we all should know by now, the media plays a huge part in shaping our views and our opinions and our emotions. And after all, it's the bad news that sells. As a company, Hewisons have taken a somewhat more positive view of the future for Australia. We recognise that bumps are going to exist along the way, but that in the medium to long term, the future does look very bright. And of course, we'll continue to keep you updated with all of these issues throughout our website, blogs, market updates, and obviously our quarterly newsletter. And so we move on to the topics for discussion this evening. As I mentioned, we do not have all the answers to the world's financial unknowns, but by the same token, we don't see that as our job. Our job is to devise appropriate technical and investment strategies that offer you, our clients, protection from whatever the financial winds are going to blow our way. Although some have analysed the current financial crisis and concluded that it's different this time, our founder and CEO, John Hewison, is going to explain to you all why, in fact, it isn't different this time.
I'm going to look at investment markets, and in particular the share market, and exploring some of the theories, the myths, the facts and the fiction, and hopefully make a bit of sense of it all for you. All investments share similar characteristics, so that what we're going to refer to in terms of the share market really applies to all of the investment sectors. We firstly should remind ourselves just what the share market is. The share market is a secondary market for the purchase and sale of shares in publicly listed companies. So let's put that into context. If I was to say to you that Hewison Private Wealth wants to sell some of its shareholding to raise capital for expansion, would you buy some? Or would you want to learn a little bit more about Hewison Private Wealth before you bought? Of course you would. You'd want to know the financial background, you want to know the owners, you'd want to know how much risk, you'd want to know how much debt we've got, you'd want to know how much profit we've made in the past, what our future plans are, etc, etc, etc. So why would we just buy shares without doing exactly the same thing? But unfortunately, the share market is just that sort of a beast that people get carried away with it and get a hot tip, and all of a sudden, without asking other questions, they're buying shares in a company they know nothing about. So we're going to look at some of the theories about valuations, and unfortunately, the share market's also been confused by a lot of synthetic products that have come out of the share market, like futures, options, shorting the market, and the recent market downturn was heavily influenced in the early days by the short sellers, which had some disastrous effects. Throughout my presentation, I'll be quoting this man, Warren Buffett. Warren Buffett is the world's most successful investor, and certainly a lot of Buffett's philosophies and theories we support and use in the way that we go about evaluating markets and individual investments. There have been thousands, literally thousands of books and academic papers on theories to do with share market trading. And most of the writings are how to beat the market. Is it possible, in fact, to beat the market? The efficient market theory espouses the theory that the market always prices efficiently. In other words, on a minute-to-minute, day-to-day basis, that the prices that apply to shares have taken into account all of the available information and price accordingly. And that's probably quite true in a certain sort of small view of the market. So some of the the better known exponents of researchers of market theory are Eugene Farmer and Kenneth French, who have in fact written a number of papers about the market and particularly concentrating on the efficient market theory. And in their early studies, they supported the early market theory and really came to the conclusion that the market could not be outperformed. In their later papers, they took a different view, and the different view is because they expanded their time frame. And by expanding their time frame, they discovered that indeed, at times, there were mispriced shares, and it was able, if you were able to discover those mispriced shares, then you could indeed outperform the efficient market. Dominic Dupont and Richard Thaler carried out a study between 1985 and 1987 looking for undervalued opportunities, and their concentration was on price to earnings ratio. Price to earnings ratio basically takes the company's earnings, divides it by the number of shares that are on issue to come up with a earnings value per share, and then then calculate a multiple between the earning amount and the share price, how many times the earnings are relative to the share price. And over the broader time period, they found that indeed there were times where there were shares that were clearly undervalued by comparing their price to earnings ratios to similar companies in the same sector. A famous book is called Random Walk Down Wall Street by Burton Malkiel, written in 1973 and has been updated since then, the latest version being 2003. And the Random Walk Down Wall Street studies a number of different investment theories and practices and looking at, again, the ability to come up with some sort of formula for outperforming the market. And basically Malkiel's findings were that he believes that the market indeed prices randomly, that there's no pattern that you can predict, and shares will price themselves randomly depending on the information available and the circumstances at the time. There are basically two methods that are most used in evaluating shares. The first is called technical analysis, and technical analysis, also known as charting, takes the trend in prices of a share over time and strikes trend lines. And in doing that, it will have prices of resistance at the top and bottom of the scales. So that as the trend lines break through the resistance lines, they're buying signals. So if the trend's going up, breaks through the buying resistance line, the chartist will say buy. And if the trend lines go down and break through the lower resistance lines, the chartist will say sell. Now clearly, that to me is a recipe for buying at the top and selling at the bottom. But in any event, chartists are a little bit loopy, I must say, and I do know some of them, and I haven't seen one yet that's been successful. This is an idea of what a share chart looks like. So we might just go on from there. But basically, it takes the peaks and troughs and draws trend lines from them. Buffett's view is that an investor of today does not profit from yesterday's growth. In other words, there's absolutely no point in looking backwards because it doesn't relate to the future. The other form of analysis is called fundamental analysis, and it relates to the fundamental valuation of a company, taking all of those things that I talked about before, all the financial facts and figures and any broader information to strike an intrinsic value of the business. In other words, what's seen as being the core value, the core reasonable value for a company, and making buying and selling decisions relative to that value. The research favours the effectiveness of this analysis, but argues that as markets price efficiently, there's still no purpose in attempting to outperform the market by using this method. But most importantly, the research showed overwhelming evidence that a buy and hold strategy will always outperform an attempt to time the market. so that if your investment decisions are correct in the first place, that you've evaluated a quality stock at a quality price, then buy and hold is going to outperform the attempt to buy and sell and look for winners all the time. Buffett's view is that our favourite holding period is forever, and only buy something that you'd be perfectly happy to hold if the market shut down for 10 years.